Timescales, time zones and orders. Timescales. When you start to trade on Forex, you will need to determine your timescale. The timescale is the amount of time you are going to stay in a trade. The three timescales are long-term, medium-term and short-term. Long-term timescale. This timescale can mean a few weeks, a few months or even a few years. If you decide to invest long-term, you would analyze daily and weekly charts to make your trades. The benefits of a long-term timescale include lower transaction fees, lower stress since you aren't watching every peak and valley of the market, and more freedom to be away from your computer. The drawbacks to investing long-term are that you have to set your stop losses a long time ahead to avoid losing a lot of money on a correction. You must also be patient. You will have to have a lot of capital to support the large variation of the market, and you will incur and have to endure usual weekly and monthly losses. Medium-term timescale. This timescale can mean a few hours or a few days, so you would analyze hourly charts to make your trades. The benefits of a medium-term investment include more trading opportunities, less risk to lose money over a month, and the ability to diversify your portfolio. The drawbacks to medium-term investing are that you will have higher transaction fees, there is an overnight risk, you have to keep a regular eye on the market, and higher stress levels. Short-term timescale. This timescale can mean a few minutes to a few hours, so you would analyze minute charts to make your trades. The benefits to trading short-term include a high number of trading opportunities, no overnight risk, and quick results. The drawbacks to short-term investing are that you will be under an immense amount of stress. You have to have a lot of time to watch the market, your profits are limited, but so are your losses, and high transaction fees because you are placing a lot of orders. The timescale you choose is going to depend on your personality and goals. It is best to practice using all timescales on a demo account before you try the real thing. This will help you determine which investment style you prefer. Time zones. As mentioned previously, the Forex market is open 24 hours a day between Sunday night and Friday night. This means it is an excellent opportunity for traders to trade whenever it's most convenient for them. However, as traders gain more experience, the time of the trade becomes more critical. This is because the best time to trade is when the most trades are being made. This will give traders a great chance to take advantage of good trading opportunities and reap the profits. Slow markets can actually be a waste of time and effort. You need to know when the various markets are open so you can find the busiest time of the trading day to make your move. When you look at these hours of operation, you can see that there are 3 sessions that overlap. New York and London overlap between 8 AM and 12 PM EST. Sydney and Tokyo overlap between 7 PM and 2 AM EST. And London and Tokyo overlap between 3 AM and 4 AM EST. So, if you are looking for the best times to trade, the Euro-US dollar and the Pound US dollar currency pairs would likely provide good profits during the 8 AM to 12 PM EST overlap session. You are going to find the most trades during this time and other overlap times. These are the times you will have more opportunities to make good trades. Types of Forex orders. The word order refers to the ways in which we will enter or exit a trade on the Forex market. You will want to verify which kinds of orders your broker will accept before you decide which ones you want to use. Market order. This is an order to buy or sell a currency at the best available price. For example, if the bid price for Euro-US dollar is 1.215 and the ask price is 1.219, and you want to buy this currency at a market, you would be buying it at the price of 1.219. Pending limit order. This is an order that you would place to buy a currency below the market or sell a currency above the market at a specific price. For instance, if Euro-USD is trading at 1.2070 and you will want to go long if the price gets to 1.2050, you can sit at your computer and patiently wait for it to get to that point and use a buy market order, or you can set a buy limit order at that price and you can go and do something else. Your order will be automatically executed at the price you set. Let's see how sell limit orders work. You assume that the price will go up and then reverse, so you place a sell limit order above the current price in order to profit off of the future retracement. Pending stop order. You would place this type of order to sell below the market or buy above the market at a specific price. You use this type of order if you think that a price is going to move in one direction. For instance, you want to join the upward trend if it gets stronger, so you place a buy stop order above the current price. To join a possible downward movement, you can place a sell stop order below the current price. Stop loss order. This is an order that is designed to help traders keep from losing additional money if the price goes against what you thought. This order will remain in place until you have to use it or until you cancel it. This kind of order is very useful if you don't want to sit in front of your computer all day, constantly worrying about losing all your money. Trailing stop. This is a specific kind of stop loss order that moves as the price moves. Your trade will stay active as long as the price does not move against you by 20 pips. If your trailing stop is hit, your stop loss will be triggered and your trade will be closed. Be aware that some brokers will charge rollover fees if you keep a trade active for more than a day. It is important to check with your broker before you place any orders.